Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, June 11th, and then we'll see how things look for Wednesday, June 12th. Had another update. On a positive side, both in Monday and Tuesday session, we had a lower open and then gradually worked our way back to end higher. That's the positive thing. But we're seeing an awful lot of weakness coming into the market that is developing now into a lot of negative divergences. And at the same time, even though we have the NASDAQ and NASDAQ 100 closing at new all-time highs, they're right at overhead resistance. So there are some things to be concerned about with what's happening that way. We have two major things that will be coming out in Wednesday's session. CPI is going to come out before the market opens. And then at 2 p.m. Eastern time, the Fed will make their announcement. They'll put out their little report. There'll be the press conference, and then the market will react to that. So there's a lot to digest in Wednesday's session to see, is this negative divergence and weakness that we've been seeing going to get dealt with and actually improve? Or is it going to suggest that maybe we've hit overhead resistance? The weakness that we've been seeing is going to continue to grow, and we might see things pull back. The market is still not trending right now. It's trying to. The ADX is trying to show that a trend is developing, and we are positive in that regard. But we need to see some follow through, as the market is rather indecisive, at least when it comes to the entire market. It's really reached a strong conclusion when it comes to the high tech, large cap growth stocks. Please know that the SPXInvesting Program has launched for the month of June. It is free. If you want to check that out, there are links not only to other videos talking about the program, but also a link that will take you to the SPX website itself. Now let's go back and talk about what happened. Right at the open, we had a lower open, just like in Monday's session. Prices hit resistance then at the daily pivot at 53.53. And that seemed to be what was happening, at least to start off with. Finally, we were able to break through the daily pivot and the unchanged level and then close above R1 at 53.74. So some more late day strength coming in. We were up 0.27%, not a huge move up. And volume is still just a little bit above average when we look at it for the S&P. We are positive in the short, intermediate, and long term. We have our short-term indicators that are looking extreme. We have these negative divergences, some weakness starting to come into the market that is causing more and more of a concern as it continues to go on. And it'll be about inflation and interest rates in Wednesday's session. And then what is the Fed going to say? They're probably not going to do anything with interest rates. It's going to be about what they say and how they say it. Some comments. The S&P, the NASDAQ, and NASDAQ 100 set new all-time highs. Early weakness saw an improvement later in the day, and that's encouraging. That just means that the smart money is coming in later and actually doing some buying. And some of our smart money indicators are what's showing more strength currently. The mega caps did outperform. That's the real focus of the market right now. And these negative divergences are becoming more pronounced. I'll go through the charts and show those to you. And the NASDAQ and NASDAQ 100 are at resistance. We have our regular list now on a short-term basis of extreme positive indicators. The Stochh RSI, the Williams Percent R, CCI 14 and 20, the stochastics, and the RSI based on 9 periods. Intermediate term, we have the Arun indicator, the Chaikin oscillator, and the ultimate oscillator are extreme. We'll see if this scenario changes after Wednesday's session, that the Fed is keeping rates higher for longer because inflation hasn't been coming down like they would like. That will be very telling before the market even opens with CPI coming out. They're still looking at the possibility of the first rate cut being in September. And there are these kind of looming economic growth concerns that are causing some issues with the market. The dollar was up and interest rates were down. The dollar going up is not really having a negative impact. It may be holding stocks back a little, but interest rates going down, that helped give support to stocks. We closed at 4.4% for the 10-year yield, or it had been at 4.47%. We're still inverted with the yield curves. Sentiment is still neutral at 46, where we had been at 48, which is kind of strange. We had an up day and sentiment actually ticked down. We're still not trending. We're getting close, but the ADX is trying to develop a positive trend. Now, if we end up going down or seeing a down day, that's going to throw this a bit into check, and it's going to take a while for a new trend to develop. But if we continue to go, if we continue to go to the upside, then the trend has a potential of at least getting a little bit stronger and actually changing into a trend. The bias is positive. We had 2 up days now, and our momentum continues to be positive. We just had the NFIB Small Business Optimism report that came out. It came in at 90.5, which is up from the 89.7 that we saw last time. This isn't really influential, but I still like to look at it anyway because small businesses are what really drive the U.S. economy, and most folks, that's what they're involved in. Here is a chart showing how it did show an improvement and has been over the last couple of months. Some Isabel Net blog charts, the technical overbought, oversold composite. Anytime we get up to a high reading above 80, which is where we're at now, the market is considered to be overbought. And so looking at this and then looking at some of our short-term indicators, we are also seeing that confirmed. Then looking at the S&P 500 and the advanced decline line, this is one of the negative divergences, and I'll be going through this more when I look at the charts that I produce here, where we're making a higher high with the S&P, and we did make a higher high earlier, but we're now making more new all-time highs, but that's not being confirmed, especially when we look at this based on price. Now, that's the negative side, but there's also the positive side that volume is still holding up, at least to a degree, and you'll see that when I get into our charts. The exposure to gold, it's dropping off a little bit as gold has been under some profit taking lately. Looking at the equity positioning, still a lot of folks are into stocks right now and not necessarily looking really extreme. Short interest, there are 2 ways to look at this. These are people that have shorted the market. They sell to get in, hoping to buy back at a lower price later. That's negative when it gets to a high reading, and it is going up slightly. But at the same time, there are alternatives to this, like using inverse mutual funds and inverse ETFs that go up in value if the market goes down. There's also a positive side to this, meaning that if we really start to move to the upside and these folks start to lose money because they have really high restrictions on their accounts, they can't just let something ride and have more and more losses along the way. They have to come in and actually close or cover that position. And that means they have to buy. Since they sold to get in, they have to buy to get out. And that's what we can see as a short cover rally at times. And then exposure to equities here is also showing that we're getting to a high level, but could still get even higher. And then while buy the dip trends have generally worked since the introduction of what's called the Fed put, this is where the Fed comes in and keeps the market from falling too much. I'm not a buy the dip person. If you watch these videos for very long, because you know that I don't hold on to that basic idea, because what is a dip? I mean, you have a down day and maybe we're starting to bounce back up and you think that's a dip, but then we end up falling even more. So there's a lot of subjectivity that goes into what the definition of a dip is. I like to buy into strength and I like to sell into weakness. I want to see the market moving in the direction of the desired position that I have and then just jump on that while it's actually happening. But it does work for folks along the way and has now for the last 20 plus years. Core PCE and CPI, these are the main inflation gauges that are followed. Where we look at the CPI, they do expect it to come down. I've also seen other reports that expect it to see this go up in the latest reading. So this is just what Goldman Sachs thinks, where they do see core PCE actually inching up a little bit going forward. Economic surprises, this was getting down to a pretty low level. And when we get down to very low readings like this is when economic reports come out that are weaker than expected. And when you can get to too much of a good thing, where bad news was good news for the economy, or at least for the stock market, I should say. Now we're starting to tick back up as some of the reports have been more in line, but we were getting down to a pretty low reading here. And what can often happen when we get up to a high reading, even above or below, we've gone to an extreme, and then the market has a tendency to shift and go in the other direction, where good news is seen as good news and bad news is seen as bad news. And then the other tech positioning with the mega caps and tech stocks here, there is money going in, but they're not necessarily at an extreme point, according to this chart. I found one interesting chart on Twitter. This was actually a post of a letter from Elizabeth Warren sent to the Fed to say you should cut interest rates on Thursday. I mean, now on one hand, it's like what was posted here. It's like the Fed is supposed to be independent. Okay, you can believe that or not believe that, but when it was initially designed over 100 years ago, they're not supposed to be come under political pressure. And it's not just Democrats that do that. There were times when the Fed would raise or lower rates when Trump was president, and he'd be sending out tweets saying, "What'd you do that for? You need to lower rates, stimulate economic growth." But then does the Fed even pay attention to this? Probably not. They're not supposed to. But now something is on record as saying that Elizabeth Warren says you should cut rates. The European Bank already did that. We want to be like our friends, don't we? And on the other hand, you can take this and look at it and go, all right, well, somebody's admitting that maybe Bidenomics isn't working for everyday people the way they thought it was. So there's a couple of ways that you can take this. But now there's an official record, and you can Google this to find the whole letter itself. I just went to Google and typed in letter from Elizabeth Warren to Fed, and this popped right up. It's a PDF that you can download and read the entire letter. There's an awful lot of footnotes in there too. Here's our intraday chart where, just like in Monday's session, we gapped lower. We were able to set up a base just about at the pivot point from Monday's session. And then we came up, but then we hit resistance at the daily pivot. We came up here once, bounced back, came up twice. Then later in the day was when we finally broke through the daily pivot, actually got above the unchanged level and closed at the high for the day. And that's encouraging. Here's our intraday chart, not really showing us anything that we're not already seeing here. Now, this is positive, where we still see large cap growth. That's the blue line, outperforming large cap value. So on an intraday basis, it's looking pretty good right now. Also, when we do the growth to value ratio intraday for the S&P, this is going up and showing a lot of improvement. End of day, we were up with growth, where value was actually down. Growth was up or down less for the mid caps and also down less for the small caps. So looking at our charts, yeah, the ratio went up a little bit, but not really breaking out to this point. Also saw a little bit of an improvement with mid cap growth to value and a little bit of improvement with S&P growth to value, but we're not necessarily breaking out on this chart based on where we've been previously. This one is looking a little more positive. The growth to value ETFs were really going up and outside of the rainbow and actually starting to set some recent highs here, not all-time highs like were set back in 2021, but the fact that this is going up is positive. And then discretionary to staples, it actually ticked down just a little bit here. The discretionary, it's going sideways right now. And so really what's leading this ratio is what happens to staples. And they were up slightly, so that made the ratio tick down after it had ticked up on Monday. Large cap growth breaking out and setting all-time highs. This is where the real thrust seems to be at. The Wilshire also coming back and setting an all-time high. This is a broad market measure. We are seeing this breaking out when we compare large caps to small caps here on this chart as well. Our trend, you can see where the ADX is pretty much on top of the moving average. The green line is on top, but on an update to see it declining, that's not all that concerning. But we're not trending right now, but we still would default to positive. We're seeing a little bit more of a turn up here with our short-term ADX, but it hasn't quite crossed the moving average. The green line is also on top, but declining. Volume, for 2 days now, we've seen volume pick up, and we'll have to see. We thought, or at least I thought, last Friday with the employment situation report, we would see a real pickup in volume. That didn't happen. We've got CPI and the Fed coming out, and this tends to be a real gyration of a time. And we'll see if volume picks up in Wednesday's session as well. With the Ulcer Index, we're turning down a little bit and still below the moving averages. We had an up day for the S&P. We don't have the Investors Intelligence latest reading, at least yet. We ticked up with the VIX on a closing basis when we look at the line chart, and we also are showing a bit of a higher range, but close near to the low on the bar chart. The volatility of the VIX is picking up, and this could be some pre-CPI Fed hedging going on, since it's pretty much a roll of the dice as to how the market's going to react. We are still seeing where the VIX is having a tendency to show the momentum of going up. Even though we closed at the bottom here, when you measure this, the MACD is still suggesting that the VIX is going up as far as momentum. We saw a bit of a turn up with our one-day equity put call ratio chart, but we're still declining with our 5-day chart. That's positive for the market. The volatility risk premium also ticking up a little bit above the band, as there's some concern about what's going to happen, especially in Wednesday's session. We came down a little bit with this fear gauge, where we ticked up a little bit with this other fear gauge. So seeing a little bit of contradiction there. This is where we're starting to see some negative divergences. We're setting an all-time high with the S&P, but price is starting to show a negative divergence. That's the bad part of the bad news. On the good side, we're showing a little bit more strength here when we look at volume. So there's a positive and a negative to take away. We are seeing more new highs than new lows, but we're not really breaking out, even though the S&P is setting an all-time high. With our 5-period, we're flat. We're starting to bottom out, it looks like, with our 10-period moving average. And this is also, in the short term, the blue line is below zero. The red line is above zero. So we're seeing another contradiction here. This is looking solid, though. Accumulation distribution is above the moving average, and the moving average is going up. Now, I wish I could do this, and I've tried to say, okay, how far away is the indicator from the moving average? It's very similar to the boom indicator that I have. And because this is an indicator, I can do it based on price, but I can't do it based on an indicator. We just kind of have to eyeball it here and see. But it looks like the blue line is getting kind of far away from the red line. But there's nothing mathematical to necessarily back that up. It's just more what we're observing. The chicken money flow is still looking positive, and the red line's going up, another smart money indicator. The chicken oscillator is breaking above the red line. Now, you could say that it's starting to get extreme, but we could still go higher with this oscillator. And we did decline with the cumulative advanced decline line here with the NYSE. We also declined with the NYSE advanced decline line, the regular one. We also declined with this other advanced decline line. This is where we're seeing some potentially positive divergences, where we're declining more with the common stock on the NYSE based on price. We're declining, and notice how we surpassed this previous low with the NYSE. We still haven't come down to that same level based on volume. So that can be taken as positive. We're seeing a similar thing here with the cumulative advanced decline line based on price for the S&P, where we're coming down a bit based on price, but not coming down as much as at least yet based on volume. But we're seeing some weakness here. The advanced decline line studies, NYSE common stock dropping below its moving average, coming down but still above the moving average with the S&P. The mid caps and the small caps are dropping further below their moving averages. Here's our daily chart. Not really seeing anything unless we really break to the upside. We have some pivot points, and we have this 50-day moving average. For the second day now, we have been above average with volume. Here's the Stochc RSI, which is now extreme positive. The Williams percent R is extreme positive. The CCI 14 and the CCI 20, and our stochastics on all different time frames are extreme positive. So our short term, you can take that a couple of different ways. That we're looking overextended to the upside and due for some kind of a pullback, or that this is just suggesting that there's good momentum. But some of the negative divergences that we're seeing in other areas wouldn't necessarily lend us to saying good momentum, because it's just a few stocks that are really driving the indexes higher, or at least the S&P. We're looking okay here with our 20-period double and triple exponential moving average study. We're just a little bit above the lines, and the lines are going up. But we're going down when we look at the 20 period, 50 period, and even the 200 period moving average study for the S&P. The force index is still positive and above zero. We're still looking okay with our regular moving averages. And we're still in the +2 channel. We're not necessarily extreme with our standard deviations chart. Intermediate term, we actually ticked down a little bit with the balance of power. We've been dancing right around this 0 point as the market is more at a point of equilibrium, trying to decide, according to this indicator, whether we're going to go to the upside or to the downside. The go, no-go system, which is a trend following system, it is still positive. The highest high value is still positive. The TTM squeeze continues to decline, but it's still positive. The 50 period double and triple exponential moving averages, this is more intermediate term, and we're still looking okay here. We're above both the blue and the red line and going up. Now we have another one, the CMB composite. I think I forgot to put that on the list. We're getting an extreme positive reading with this indicator. The 50 period moving averages, we're just following these in case we see a pullback. If we break through the 20s, the next logical point would be the 50s. The ease of movement is still positive. The Arun ticked up, and we're starting to get an extreme reading when we look at the oscillator here. The green line is pegged all the way to the top, and the red line, and the green line are buyers, the red line are sellers, and it's pegged all the way at the bottom. That's why we're getting a really extreme reading right now. This is where we start to see some more negativity and negative divergences. The S&P is going up and making a new all-time high. The McClellan oscillator is actually negative and declining. So this is another negative divergence. We're going up with the S&P. We did have another negative divergence here as the S&P was going up, but things worked out okay that time. But we do see the summation index based on price as well as volume now declining. And the NYSE McClellan oscillator below zero and declining as the S&P has been going up. That's a negative divergence. So with the summation index for the NYSE based on price and volume, we continue to decline. The Swenlin trading oscillator, we're below zero, so that's negative based on price. We are declining, but still above zero based on volume. So that's a bit of a mixed signal. The PMO and our other oscillators, they're trying to improve. They're slightly above the moving average when we look at the PMO itself, but we're still negative when you break it out based on price and volume. And we declined a little bit with the PMOs that are rising. We're starting to turn down slightly with the buy signals, and we're flattening out with the PMOs that are above zero. We're still positive with the Elder's Impulse system with the S&P. We're positive with the parabolic SAR. The slope oscillator is trying to turn up, but it's still below its moving average. The MACD is about on top of its moving average right now. So looking at our oscillators, it's trying to show some improvement with the slope and the TSI. Those are short term. Intermediate term, the MACD is trying to improve. The PMO and the PPO are trying to improve. Longer term, with the tricks and the KST, they're still flat and on top of their moving averages. We're still above all of the plotted moving averages here. And we declined with the bullish percent index. Now, it's still positive because we're above 50, but the fact that we're going down is also something to be concerned about. We're declining with the NYSE bullish percent index, but we're still above 50. This is a concern. The NASDAQ 100 setting a new all-time high and the bullish percent index going down. And it's also negative since it's below 50. The money flow for the S&P is still positive. We're still extreme positive with the ultimate oscillator. The vortex, the green line's on top, but it's really flattening out. It's not really showing any conviction right now. The RSI 14 is still looking okay. We're above 50 and not extreme. Where we're starting to get extreme with the RSI 9. That's the shorter term period that we look at. On balance, volume is positive, and we're above the advancing moving average. We're declining still with the stocks inside the S&P above their 20-period moving averages, and we're below 50. So that's negative and declining. We're wondering where we're at with this whole study here. Now, there was weakness at other times before we got set to actually break higher. So not all hope is lost, at least yet, but we're just not seeing an awful lot of internal strength, even in the short term. And we're declining and below 50 with our 50-period moving average study of the S&P. We've turned negative again now with the 100 period simple moving average. These are stocks inside the S&P that are dropping below, or that are above their 100-day moving average. It is dropping below 50. And we're declining, but still positive with stocks above their 200-day moving averages. Copy curve trying to turn up, but it's still negative. The Sean trend meter is flat and not necessarily extreme. And I wanted to show the standard deviations chart. We're seeing a bit of a pickup here. Now, this doesn't measure direction. This measures speed. And this is, even though we've been chopping around, it's the big up move that we saw is finally coming more into the calculation. So we're actually coming above the moving average. And we're just a little bit negative here when we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows. We're just barely, that's really hard to see. Is that a plus 59 or a minus 59? It's a minus 59. No support or resistance levels of note, at least for the S&P as of right now. But on a trending basis, we're still looking good with the hike in ASHI. We're looking good with the KEGI, the Renko chart, and the 3-line break chart. Then longer term, we are declining with our 150 and 200 period moving averages. We have not had a confirmation signal, at least yet, with the Hindenburg Omen indicator. We still have up until about the end of June for that to actually happen. And we're still negative with the mid caps and the small caps in the short term, where everything else is positive. And bonds are showing some improvement here in the short and intermediate term, but they're still negative in the long term. Commodities are in a downtrend in the short term. The dollar has been seeing some strength and is looking more positive across the board. We're still positive across the board here with our decision point scorecard. And we started off by seeing some negative things happening, where in Canada they dropped below 22,000. We had a bullish percent cross below 70 for the financial sector. And then the BPI crossed above 70 for the utilities. That's a more defensive area. The staples, though, crossed below 50. That's area has been seeing some weakness. We have the NASDAQ setting a new all-time high, as well as the S&P, and not included on here is the NASDAQ 100. The two sectors that were positive were tech and communication, which are growth areas, and we like that if we're positive on the market. So, but we'd like to see discretionary doing better, but it's just not. We're looking a little better here, but we're still negative when we take the NYSE new highs minus the new lows, just the raw score. We've been above zero for most of 2024. We've now been under zero for the last couple of sessions. And the equal weight is really starting to underperform the S&P. So we look at this ratio over here. This just means the mega caps are really outperforming right now the rest of the market. The Dow is coming right back up to its 50-day moving average and still below this pivot point. It was down 0.33%. The diamonds have gone from being positive back over to neutral with the Elder's Impulse system. The NASDAQ is coming right up to this R1 pivot point. Now, you might easily throw this off and say, well, these are just lines. Do they really matter? It does seem to matter for the NASDAQ and NASDAQ 100 when we hit these pivot points. If we can break through and keep going up, that'll be quite positive. But there's other times, if you look at these dashed lines, where we came up to these levels and they ended up being rather significant. NASDAQ 100 also right up at its R1 level. That is overhead resistance until proven otherwise. The Qs are still positive for the Elder's Impulse system, and the momentum is looking more positive for the NASDAQ 100. The small caps continue to go down, and they're still above this S1 level, at least on a closing basis. And we're negative with the Elder's Impulse system for the small caps. When we look at the Russell 2000 small caps, we're below 50 with the RSI. We're below the 50-day moving average. And we are negative on a momentum basis. The mid caps also not really showing an awful lot of strength right now, trailing off here and below its 50-day moving average. And they've gone from being neutral over to negative for the Elder's Impulse system. Apple, that was kind of the story stock of the day with their new Apple Intelligence and all that stuff. A lot of people were getting into this, and it was up over 7.25%, setting a new all-time high. Tesla still struggling, down 1.8% and dancing around its 50-day moving average. NVIDIA was down after setting a recent all-time high. Microsoft had a pretty good day, up over 1%. Meta was also up almost 1% above its 50-day moving average. Amazon was little changed on the day, but still above its 50-day moving average. And Google was up almost 1% and is looking pretty solid. Netflix was up a little bit over 0.5% and is still looking pretty good. The FANG index setting a new all-time high here. This is Facebook, Apple, Amazon, Netflix, Google, and Nvidia's in there, I'm sure. The financial sector is seeing a bit of a pullback and falling a bit more underneath its 50-day moving average, but we're still in a longer-term uptrend. And the staples to tech ratio continues to go down. That's positive. We want to see that continue to go down to be more positive on the tech sector. The dollar is going back up above both moving averages and is still in a longer-term uptrend as we get back up into the 105 ranges. Internationally, the S&P compared to the world index, seeing a little bit of a trailing off with our short-term correlation. The longer-term correlation is pretty much flat and not changing. The staple sector was little change, but slightly down, still above its 50-day moving average, still in a longer-term uptrend. This is also a more defensive area in the market. Utilities were down over 0.5%, but still above their 50-day moving average and still in a solid uptrend. Healthcare was down also, but above its 50-day moving average, still in an uptrend, but it's more range bound here. We're going to be watching to see if it breaks out above these previous levels. Energy, just keeping an eye on this as well. It was down 0.25% and below its 50-day moving average. When we look at the total U.S. stock ETF, it was up and setting a new all-time high. Keeping an eye on interest rates, the 10-year yield was down. That did give support to stocks. The 10-year based on price was up. And then we do some comparisons with the S&P 1500 to short-term bonds. We're still going up here. That means that the broader market is outperforming short-term bonds based on price. The QQQs are outperforming the 3 to 7 year bonds based on price. The tech sector is also outperforming 3 to 7 year bonds. And then looking at our growth to value ratios, showing some improvement here with the Qs to S&P, still seeing a real not good looking trend here with discretionary to the S&P. Large cap growth is outperforming large cap value. So we're seeing an improvement with the large caps, a slight improvement with the mid caps and the small caps. And we're still looking negative here when we look at the 19-day advanced decline ratio. We're negative based on price. We're just slightly positive based on volume. The S&P to utilities ratio is going up. That means the S&P is outperforming. To be more positive, we want that to continue. And the staples to S&P ratio is going down. That means staples are underperforming. If we're more positive, we want to see this continue to decline. So what's our outlook for Wednesday? The technicals are positive, and there is strength coming in, but it's like selected strength in the market right now. And this weakness is still there, and these weaker areas are now starting to develop into negative divergences, and they're starting to increase. We're going to get the MBNA Mortgage Applications Index, CPI, that's the biggie, and then the FOMC rate decision as well, and then we're going to get the Treasury budget, which usually is a non-event. We want to keep an eye on the geopolitical events. And then in Thursday's session, we're going to get PPI. And then on Friday, we're going to have consumer sentiment. Here's a whole block of things that are going to be happening on Wednesday's session, what the previous reading was and what the forecasts are currently. Seasonally, we're not looking good. We're down with the Dow, S&P, and NASDAQ from 2002 to 2022. Wednesday is the most negative day of the week based on what happened in 2023. We're coming out of a more positive seasonal time, and we're starting to enter into a more weaker time as far as the S&P is concerned, even during an election year. We're looking okay for right now, but it's after this we might see some negative seasonality before we might see a bit of a bounce. But this is when CPI is coming out, and so who knows what's going to happen with all that. Where longer term, June tends to perform pretty well during an election year. It's up 75% of the time with a return of 7.3%. And then we have July and August, which are also up, not up as much and not as much of a return. And then we're in that weak time now, according to Tom Bowley's research for the month of June. So our warning signs, we're still keeping this in the back of our mind. We're setting all-time highs with the S&P, with the staples and utilities not showing the strength that they were before, but they're still there. There's still something that we have to at least keep an eye on. We're also watching the energy sector, seeing if that's becoming more defensive, and then healthcare. We've been watching that one. The advanced decline lines are showing weakness with our advanced decline line studies. Growth to value and discretionary to staples, they're doing better, but they're not necessarily really leading right now. But there was an improvement on Tuesday. And the McClellan oscillator and summation indexes for the S&P and NYSE, they are negative. And in a more solid environment, they would be positive. The bullish percent index is above 50, but it's declining. And the reason why it's in gold color is that's a primary indicator. The Swenlin trading oscillator, it's negative based on price. It's holding up a little bit better based on volume. Our oscillators are negative, but showing signs of improvement. The Copic curve is negative, and now we have the 20, 50, and 100 moving average studies inside the S&P 500 that have now gone negative. And the bullish percent index for the NASDAQ 100 is negative. And then we have the positive signs. We're still going down with the 5-day equity put call ratio. We do have some positive indicators like the parabolic SAR, accumulation distribution, the Chaikin money flow, and the Chaikin oscillator. They're looking good. The Chaikin oscillator might be a little extreme, even the accumulation distribution. This is the one that I said is kind of far away from its moving average. We just kind of have to eyeball that one. The money flow, the ultimate oscillator, the vortex, and the financial sector are still positive, and the momentum for the NASDAQ 100 is looking more positive. So our conclusion, we are positive now, and we do see some strength entering, but as I said, it's more selective strength. We'll see if that can become more of a broad market strength. There is weakness that we're seeing, and it's starting to produce some concerning negative divergences. In the short term, we are looking a little overextended to the upside. Is that momentum? Does that mean that we're ready for a pullback? We're still positive in the intermediate term, but we're seeing actually more weakness developing there. And in the long term, we still continue to be positive. Thank you. I really hope you found this helpful. I hope you have a very good day, and I will talk to you in the next video.